Thank you and welcome to this discussion by CSEF Australia and Startup88. Today we're joined very luckily by the Executive Director of CAMAC, the Corporate and Market Advisory Commission, Executive Director John Kluver. We're also joined with the CEO of the Australian Small Scale Offer Board, ASSOB, Paul Neiderer. And we are hoping that we can be joined by one of the possible CEOs, Alan Crabb, who's in transit to New York later on to join us in this conversation. To get the conversation started, I might ask a question of Paul Neiderer. Paul, can you tell me what crowdfunding is and what crowdsourced equity funding is?
Well, the word crowdfunding, usually it splits into three areas. There's the debt, the equity, and rewards. And rewards is the most popular and well-known one, with sites like Kickstarter and Possible and Indiegogo. But basically, it's the ability of people to offer things, and they can be securities, over the internet, and lots of people get involved and belong or interbelong to a particular raise or effort. For crowdsourced equity funding, it relates specifically to the equity part of it, whereby people that come along to that particular website, the outcome is that if they're interested, they end up purchasing equity in the offering. Oh, you're muted, sorry. Andrew, you're muted. Are you? Oh, no?
Struggling with technology here, folks. Excuse me, I think I managed to mute myself, which is a great idea in theory. So I will ask John Kluver from CAMAC to elaborate a bit on what prompted CAMAC to seek submissions back in September 2013 on how crowdsourced equity funding should work in Australia? And does he believe that Australia is a leader or a follower in this scenario?
Andrew, first of all, on the question of what prompted the review, we go back to June 2013, when a paper came out entitled Advancing Australia as a Digital Economy, an update to the National Digital Economy Strategy. In that paper, there was a discussion of crowdsourced equity funding, and the government of the day undertook to conduct an independent review of whether crowdsourced equity funding should be introduced into Australia. And CAMAC was given that particular task. And we were requested to report by the end of April this year, but because of a lot of developments internationally, we were extended to the end of May and reported on the 21st of May. It might be worthwhile just giving a little bit of background about what's the current situation and whether crowdsourced equity funding is permitted in Australia or not. People may be aware that if a company wants to get money from the public, it can do so by going to the public and offering a prospectus. Can be a fairly demanding disclosure document. The view was that for small startups, particularly in the innovative area, that wasn't an attractive option for them. It had a lot of difficulties with compliance, and also at the same time you'd have to be set up as a public company, which has quite considerable compliance obligations. The usual arrangement at the moment for small startups is to set up as a proprietary company and to seek money from bankers or traditional lending services, or to use some of the exemptions from the current prospectus requirements. There's what's known as the 2012 exemption, 20 offers in 12 months, and also offers to sophisticated investors. They're exempt from the requirements from prospectus. But the biggest problem with using a proprietary company is our current rule that you cannot have more than 50 non-employee shareholders. So what effectively it means is that you can't use proprietary companies if you're seeking small investments from from large numbers of crowd investors. We may be talking a few $100s or even less from hundreds, if not thousands of investors, and the proprietary company structure just simply doesn't permit that. So we were asked to look at the question of whether crowdsourced equity funding in the concept of offers to the crowd generally, the retail end of the market, should be introduced into Australia, and if so, in what form. So that's, I said, is why we started the review process. On that second question about is Australia leading or following, if we look at the history, that the jurisdiction that started it off really was the United States with what they call the Jobs Act back in 2012. Having said that, however, and taking into account there are some initiatives already underway, New Zealand started in April this year, that we're still in the very early days of crowdsourced equity funding. Legislation hasn't yet commenced in the US or in Canada or in most of the European member states, so that we are, I think, very much still at the forefront. And the review that CAMAC has conducted has sought to take into account all the developments in Australia, but at the same time look to into the Australian context to see what's best if we were going to go in that direction in the future in Australia. You're muted, I can't hear. Andrew, you're still muted, I can't hear. Andrew, you're muted, I can't hear.
Seems to be a technical issue there with Wardy's system. He's unmuted himself and he's still muted, so the system's obviously decided it's best he doesn't speak.
Yes, I can hear everybody else. All right, we'll just do it without him.
I was going to say, if you want to carry on, I can try and fill in on his behalf.
John Kluver here. I can certainly answer the question about what were the types of submissions that we received through the crowdfunding. Thank you.
John, you there?
Yes.
Hello, John.
I am. Hi, Mike. John here. John Kluver speaking.
John, sorry. Mike, hey, how you going? Sorry, we just didn't seem to be able to get some connection going on. Okay, so maybe if you could go through some of the, I guess, the outlines of the recommendations.
For people who are interested in reading the report, I do recommend they go through a number of simple steps which would really assist them in understanding the recommendations. That to assist everybody, at the time we published the report, we also published with it a guide through the CAMAC report. That's a 5-page document. It's very easy to read and it's designed to really give you the overview of how the report is put together. It also refers at each part to the beginning of each chapter, which provides a summary for you of all our proposals. So, and the first part of each chapter gives a complete summary of what's in that chapter. So it's a reader-friendly document as best we can do it, given its length. So what are the essential recommendations or proposals in the report? There are a number of them. First of all, I mentioned the problem that our proprietary company structure, which innovative startups would tend to use up till now, do not sit within the context of crowdsourced equity funding. CAMAC was of the view that given that crowdsourced equity funding in effect is an offer of shares to the public, the proprietary company structure, which is designed for private companies, was not appropriate. At the same time, we recognised that the public company structure was a little bit formidable for many startups, so we proposed the introduction of a concept of an exempt public company, which recognises that you are making offers to the public, but at the same time exempts you, at least temporarily, for a number of years from some of the requirements for being a full public company. The next set of proposals deals with the requirements for issuers, that our proposals are focused on the small end of the market, that the innovative startups or small enterprises, so that the crowdsourced equity funding is not designed to be used for very large conglomerates and whatever. And because of that, we've proposed an issuer cap, that is that under crowdsourced equity funding, an issuer cannot receive more than $2 million in any 12-month period. There might be some discussion later this afternoon about issuer caps and investor caps. We recognise that they're arbitrary figures, but they do give some indicative indication of the sort of companies that we're thinking about. Also, to make an offer to the public, we're proposing that there be disclosure requirements, so they be standardised and in a template which would both assist issuers in understanding what information they have to provide to the investing public, and also would assist the investing public because the offer document would be a template standard for all issuers. It makes it much easier for crowd investors to compare one offer with another offer. So that's some of the principal recommendations regarding issuers. The next set of recommendations regards the intermediaries. That's the online portals that will be the intermediaries between the issuers and the investors. With those, we're proposing that the intermediaries conduct some limited due diligence checks on issuers. They check some compliance with caps, and they also facilitate communication between the investors. Finally, with investors, we're recommending that investors or crowd investors receive risk warnings before they invest, and that there be investor caps involved, and that is that an investor cannot invest in a year more than $2,500 in a particular issuer, or in total with all issuers more than $10,000 a year. That's really the essence of some of our recommendations.
Thank you, John. I'm hoping that everybody can now hear me.
Sorry, John, did you say more than 10,000? It just broke up then.
The 10,000 maximum per year that an individual investor can invest in through crowdsourced equity funding.
Great. Well, Paul Neiderer, can I address the next question?
You've got syndicate leads who are investing. Hello?
Sorry for the confusion here, Mike. I think you're on a slight time delay to the rest of us. I'll let you finish your question to John Kluver, which was about a comparison with Angel Invest, I think.
Okay. Yeah, you take over. Yeah, cool. John, thanks very much. Compared to AngelList, where you've got popular investors, so to speak, or lead investors, leading syndicates of people, that would seem that $10,000 would probably not facilitate that sort of leadership. So, for example, if you had a local guy like a Mike Cannon-Brooks or one of the successful guys who've had some big wins, it seems he'd be unlikely to be able to participate via that method or lead a syndicate via that method. What would you say?
My answer is this, that the 10,000 limit refers to retail investors. However, we are not seeking to change the current exemption that applies to sophisticated investors. Currently, sophisticated investors can invest in companies without the requirements for a prospectus. That exemption that currently applies, we don't suggest there be interference with it, so that therefore people who classify or can be classified as sophisticated investors or very large-scale investors, $500,000 or more, the exemptions from the disclosure requirements that currently apply will remain in place.
So you could see that those people could lead a round with a whole bunch of investors behind them. So the smaller retail investors walking in behind a large angel that's exempt from regulation.
There's no problem with that notion, assuming that CAMAC proposals get up. All this is on that basis. There would be no problem at all with a lead investor being a sophisticated investor.
Yeah, that's a good solution, I think. Andrew, did you want to go back to questioning?
Yes, please. Thank you, Mike. I'll get some comment from Paul if I could. Paul, hopefully you can hear me, but ASSOB has been described as the longest running direct equity and crowdfunding portal. And I guess from your perspective, why was CSEF legislation required in Australia if we've already got the capacity to do it here?
Well, just as John was saying that there are excluded categories in the legislation which cover sophisticated investors, and also a small amount of retail investors up to 20 and 12 months in a year. So that was what John also mentioned. So this covers the, you could say, the true essence of volume crowdfunding, and that's what was addressed in the report.
Great, thank you. I will ask John, I believe that you've made a summary of the CAMAC recommendations whilst I was struggling with my technology at my end. So I guess I'll throw it back to Paul and ask, what's your view of the CAMAC recommendation? What were some of the highlights for you that, and what were some of the concerns that you may have had as a potential intermediary and somebody who's familiar with the space?
Yeah, well, I think they did a great job on the report. Like, as John said, they delayed because there were lots of announcements coming out, say in April, about other platforms around the world. And what evolved in the end was really best practice around the world. They did a superb job, and I think that was really good. I suppose in terms of, you know, looking at it within the context of startups and small businesses, when you've been in the game as long as we have and had 300 raises for $138 million, you realise that you aren't going to get 200 investors putting in $2,500 to get $500,000 straight up, unless you've got something that's incredibly viral and attractive. And so what often happens, there needs to be a mix of investor types, and especially in the early parts of the raise, they're going to be people like friends and fans and family and followers that come into that raise and support it in the beginning until it gets to that level of attractiveness that you can go into what they call the third level of survival, which is not friends or friends of friends, but over to people that you don't actually know. And so the difficulty for me is, based on our statistics, we find that each of our raises attracts a crowd of around 670 on average, and from that around 300 download extra details about the raise, and about from 22 to 22 end up investing. But to get that volume into it, often it's and to get that crowd volume, it would have to be a fairly special raise.
Great, thank you very much. Mike, can I ask you a question as a veteran VC here? Do you view the rise of CSEF as a threat to the established angel and VC community, or something that the angel and VC community is looking to embrace and partner with?
So I probably should clarify, I'm not technically a investment fund. We tend to invest in intellectual property versus straight into companies. But what I'd say to you is that I think there's a place for both. So I guess I don't have a vested interest is the first thing to say. I think there's a place for both, but I think, if you look at what's happening in the US at the moment, I think very definitely, for example, AngelList is disrupting what's happening in the seed rounds. And if you think about, a VC typically now to get into the best companies has to compete pretty hard, and a lot of those will miss out. So if you've got this angels displacing this angel to be able to, say, for the VC to be able to get into the Series A and the Series B. If they may miss out on the A, and that's where they're going to make the money. So again, coming from a non-interested perspective, I see it's definitely going to make a big difference to the VC model in general. I think VCs are moving further up the chain, so to speak, or later in this series.
Thank you for that feedback, Mike.
Signs.
And yeah, I think it did. John, if I could come back to you and we could talk about process a bit more. What would normally happen with CAMAC recommendations once they're submitted to the Minister for Finance? What would be the normal process after that submission from CAMAC?
Before I answer that, could I just make a comment and follow up on what Paul was saying earlier about what's the possible level of take-up of crowdsourced equity funding. And it goes back to an earlier point about when I looked at the submissions that came in. We can say that most of the submissions, well, predominantly the submissions, either reflected potential issuers or intermediaries or parties that tend to be associated with those groups. We didn't get any submissions in themselves from our retail crowd investors. It'd be a surprise in one way if we did. But what it does mean is that the future of crowdsourced equity funding, not only in Australia but globally, is dependent on one of the great elements that is yet remains unknown, and that is what is the likely level of crowd interest in taking up shares in a company in return for parting with their cash. It is a very important element to take into account. That's one of the things that we've sought to balance in our report, to make it sure that while taking up equity in an innovative company, like taking up equity in an established company, is always a financial risk, there is a high level of financial risk, particularly with companies that haven't yet matured to the level that normally is associated with public share offers. And from that point of view, what level of appetite there will be in the public is unknown. It may well be that we go through a series of stages with crowdsourced equity funding if it's introduced into Australia and elsewhere. I think initially, I think there may be two factors will apply. The first is there will be I think there's a built-up pressure from issuers. There's a lot of people out there who probably would be very keen to launch their offers as quickly as possible once the legislation is introduced. So there may well be a high level of issue interest in the first place. There may also, from the investor's point of view, be a level of novelty effect. This will be a new way in which you can put in money. It's a relatively easy way to put in money, and people might think, well, I'll put in $200 here, $100 there, or whatever. You know, what the heck? It might be interesting, and it might be a worthwhile punt. What we said in our report, and I'd reinforce it, is I think we've got to make sure that we don't move to a judgment on the effectiveness or otherwise of crowdsourced equity funding to assist the innovative sector too early, because I think these two effects, and that is the pent-up issue of pressure and also the novelty effect, might take a while to work through, and it may therefore be even a number of years before we can say as a long-term factor how effective crowdsourced equity funding will be both in Australia and in other jurisdictions as a form of assistance to the innovative startup. So that was just a general comment I had. On your particular question, what happens with CAMAC recommendations once they're submitted to the Minister? Well, my answer to that is very short, and that is it's totally a matter for the Minister. So far...
Continue, please, John. Yeah, you were about to say something else.
Sorry, yes, so far, the day after it was published, there was one ministerial statement that reinforced the government's support for the innovative sector of the Australian community. But beyond that, there hasn't been any statement at this stage at all, so we will all be awaiting developments.
I'm sure, John, that you have far more experience understanding the machinations of a government than I do, but it would appear that the government has a series of budget-related bills that it's trying to pass through, and I guess, is it a reasonable assumption to assume that this legislation won't be rushed through in the next month, but maybe in the next calendar year or potentially 12 months from now? Would you have a comment on those sorts of timeframes?
Well, the first thing I do, but I'll make clear this is just purely personal speculation. I don't have any inside knowledge on this at all. I'm reliant totally really upon my many years of experience of the way in which this type of legislation would operate and be introduced. I would anticipate that it will be some months at a minimum before any draft legislation would appear. I would anticipate that it would be in the form of a draft legislation with requests for comments, given particularly the innovative nature of this area of corporate law and the interest groups involved, and the fact that that these interest groups, including Paul, have only seen the report recently and may have views that they might wish to put to the government on the particular draft proposals. My guess, and again it's just a personal guess, would be that we would go through a draft legislative stage with Treasury courting possibly for some views, and on that basis I would have thought that the earliest we'd be looking at the introduction of this would be sometime early next year or sometime next year. I would emphasise that's not late. It's not a rush to grab this area of the economy. It's not going to disappear or be used up in a very short space of time. I would emphasise that crowdsourced equity funding, like all forms of funding, should be seen as a long-term process, and that's why it's important that we get the legislation, we get the best possible legislation we can in Australia, consistent with international approaches, and at the same time give ourselves plenty of time to see how it'll work.
Great, Mike.
Unless,
I think
of course,
you
you're
had
actually
a comment
trying to raise
there
it and you're waiting on the cash to support you. Yeah, unless you're actually waiting on the cash or trying to raise the capital and your business is, I guess, sitting there looking for a means to fund. I can understand, you're absolutely right, you can't hurry the legislation, but I guess startup businesses and government have different timeframes, vastly different timeframes.
It's always open, sorry, John Kluver here again, it's always open to individual parties to approach the government on any particular matter and seek clarification, assistance, whatever they wish to do. I mean, the process is now with the government, and what their response will be, the nature of their response and the timing is a matter totally for the government, and that's something on which interested parties can and could be encouraged to express a view to the government.
Thank you, John, for that response. I'm going to go off script and ask a question which has come from the British experience. In England, two equity crowdfunding platforms, CrowdClan and Seedrs, have emerged as the primary business models for intermediaries. Do you anticipate a number of intermediaries in the Australian market, or a singular intermediary? And do you think these intermediaries will divide by any geographical or industry-specific alignment? Do you see any way in which you would anticipate the intermediaries emerging if and when legislation is put into place? And I'll direct that to John Kluver first, and then Paul, I'll ask you to make a similar comment if I can.
First of all, in relation to the UK, it's correct that there are some of those significant intermediaries. The UK legislation adopts a different sort of approach than what we're proposing in Australia, so there's a limit to which we can sort of draw upon the UK in this context, that we're looking a little bit more to what's happening, say, in the North America on crowdsourced equity funding. In regard to intermediaries in Australia, the thinking is that intermediaries will play a very important role in ensuring confidence in the crowdsourced equity funding process, both for issuers who have to deal with the intermediaries and investors. From the investors' point of view, they have to have confidence that the intermediaries are acting as neutral agents, that they're not, they don't have a self-interest, there's not a conflict of interest, they're not unduly or pushing a particular product because they have an interest in it. And because of that, and because of the professionalism that intermediaries need, we have recommended, and this is consistent with approaches in other jurisdictions, that they be licensed, that they have an Australian Financial Services licence, and that licence there be particularly tailored for the needs of intermediaries. Subject to that, it's up to any party who believes they have the skills and the capacity and the interest, if our recommendations are adopted, to seek a licence from the Australian Securities Commission once it's started. We're not suggesting there be any monopoly at all, that if competition sets up between intermediaries, between licensed intermediaries, that may be for the benefit both of issuers and investors.
Paul, would you care to tackle the same question?
Well, the UK is interesting because CrowdCube's been going for 3 years now, and CEDA's a little bit shorter than that. And what's been interesting in there, I know that John said there weren't a great deal of stats about it, but you can invest as little as £10 in CrowdCube, and whereas in America it's all unaccredited and all accredited investors. But what it's shown that the number of investors raised has been has been around about 100 on average, which is a little bit higher than our experience, but then we do have the 2012 to contend with. But it shows that the platforms there have established themselves and their governance and things like that in order to match the market. And I think in terms of Australia, it will be just as John will say, that companies will be established sometimes in niches, sometimes generalists, but all of them will have some degree of governance from the authorities in terms of good operating rules. Like for ASSOB, it's taken us 8 years and having a continual internal legal counsel to build up a structure of compliance, and it's no easy job. And these people that are raising capital, they don't know anything about being a director, running a company, issuing share certificates and things like that. We can list a list of 100 different things that you find in every offering, that even a small one that needs an entity that actually takes responsibility, and as John said, gives the credibility to that actual handling of that raise. So I think it'll just develop as it develops. But what's interesting in the UK, like CrowdCube's got a direct investment model, whereas CEDA's, you invest into a fund and then into the entities. So you'll find that there will be different forms probably that develop as we move along.
John Kluver, do you have any comments as to your hopes for a secondary market? I know it's not prohibited in the CAMAC report, but would you think a secondary market makes it safer or less safe for investors in that scenario?
It's certainly in the interest of the crowd investors that there be a secondary market if at all possible. We have made that clear in the report, and when we were looking at the question about whether there should be any restrictions on the resale of shares from the crowd investors once they purchase them, we said there should be no restrictions whatsoever. So whether a secondary market will develop in particular shares is an unknown, but we certainly don't want to put any legislative barriers in the way of a secondary market in those shares. Having said that, we did put one qualifier on it, and a very important qualifier on it, and that is we were a bit concerned about a possible what's known as a pump and dump exercise, and that is where a party may set up an issuer, may seek to get money from the public, and then may sell out their own shares at a profit based upon the amount of money that they have raised, and then and as I say, leave the crowd investors, if you like, to their own mercies. So because of that, we recommended that even though there be no restriction on resale of shares by crowd investors, that directors of that issuer or other parties closely associated with that issuer have restrictions on their capacity to resell their shares within a certain period after they decide to run a crowdsourced equity funding offer. It's a matter for them where they run the offer, but if they do, they know there is a resale restriction that will apply for a period of time.
I think that's a highly enlightened piece of the CAMAC report. I guess I would ask Paul initially, and then yourself, John. What are some of the highlights that you see that have been brought out of the CAMAC report for investors that are looking at a new class of asset, I think, is probably the best description. Certainly a new market for a class of asset. And what do you think that will turn them on to CSEF?
Yeah, it's a difficult one, that, you know, it's wonderful when you get a raise that actually is really attractive to people beyond the friends, the fans, the family and the followers. And you know, maybe out of 100 in a year get 4 or 5 or something that truly do have the energy to do that type of thing. So, you know, I think it would be good if that happened, but if you're going to raise, say, $500,000 and you're going to get, you know, 200 people putting in 2,500, it's just difficult to me to see, based on our stats and CrowdCube stats, that you're going to get that momentum unless it is a truly an opportunity that has a great story, it has a great team, and has its own group of followers of the technology, the geography, or the people. And I've wrestled with this a lot because every raise that comes on board has got, you know, if they want to raise 300,000, then you've got to work out where are they going to get it from, and it's an interesting area. I think the jury, as John said, the jury's still out on this because it may take several years for the environment to be built whereby people will just have a go for a few $100s in something. But if you look at some of the things that raise money on ASSOB, like leading-edge payment systems, appliance testing equipment, GPS systems, encryption software, vitamin delivery systems, cloud solutions, wine barrel, spray-on skin, things like that, they you know, they're entrepreneurs. They want to raise money. They want to do good things for Australia, but you know, they're not going to exit often in Silicon Valley or something like that. And I know in the beginning, Michael, you were talking about Angel List and things like that, but the companies that we deal with are, if they were attractive to those people when they were seeking their crowd capital, then they probably wouldn't have any problems getting out angels and things like that. The companies that often come to ASSOB are ones that have shopped themselves round to those particular people, but they're at too early a stage. They need to get some runs on the board. They need to get some money in order to get them to that position where they are people.
John Kluver here. If I could just reinforce, I think, much of what Paul has said, that what the level of interest that the public will have in crowdsourced equity funding is the great unknown. Certainly, it is fundamental, because no matter what sort of regulatory structure we put in place, that if the crowd don't turn up, the whole thing's a wasted exercise. That it won't achieve anything. Without the crowd, there is effectively no crowdsourced equity funding regime that can operate. what will attract investors, I think, is an unknown. If you look at it from the positive point of view, you could say what it will do for people is it might, if nothing else, excite their interest, that they will start to see through intermediary websites as they become used to them and as they emerge, they will start to see things being offered. And maybe of 50 offerings on that website, one or two might just catch their fancy in a very positive sort of way. And they may be people who are prepared to put some money in on the pure possible speculation that it might be a success, even if they don't necessarily get a lot of money out of it. They might just feel psychologically that they've contributed in some particular way, that they're part of that sort of action. So they may be all those sort of very personal factors that crowdsourced equity funding gives a real opportunity for people to achieve and be involved in. There's also another area which I think crowdsourced equity funding can have an important role, and that is with public interest enterprises. We've got a number of submissions. In fact, we've got a separate discussion in our report of people who are really talking about people taking up things like community shares and whatever, where what you're looking at is something which is there for the public interest or something which they see will assist the environment and whatever. And rather than just giving a donation to these particular enterprises, some people may feel psychologically that if they buy a share in that particular company, which they believe is doing a worthwhile public cause, that they are part of that. And I think, again, there's those sort of psychological payouts. So what I would say with the crowd is, for some people, if it's just finance, it will really very much be a sort of a risky exercise. For some people who like some psychological benefits from crowdsourced equity funding, there may be some real value in it in the future.
I'd just like to carry on from what you said there, John. We've had a few people come to us, a bit like that Hepburn wind or solar power. You have a town that wants to erect some form of electricity generation system, and if they go to prospectus, it's going to cost them $70,000 to $120,000, and so they think, well, we just want 1,000 of our citizens to put in $10,000 each or $5,000 each. You know, how can you handle it? And that's always a dilemma, because you know there is only the way to go to prospectus, but at least under the new legislation, you'd be able to get some sophisticated and professional investors that could put in, you know, decent chunk. You'd be able to get some citizens, that maybe 20 of them, that would put in a large amount because they retail under the 2012, and then you probably can get a lot of citizens that just put in their 2,500. So that would solve that, because I know that's a very real need for a lot of community-based structures. But you know, when people get together and they think, well, if we've got to get 70 or 120,000 to get a prospectus, and we're not even sure we'll get the money, and that, like, who's going to pay for it, and all these things go through. So yes, I think that's a really, really important part.
Paul, I'm very glad that you brought up those community organisations, as that's my own pet project as well. And I think that there is as much interest in crowdsourced equity funding for the community enterprises around energy, water, waste, education and social services as there are around the startup community. And I'm happy to be proven wrong, but I believe that since the UK equity legislation has been put in place, about £26 million has been put up into innovative startups, what we might call apps and software solutions, whereas £60 million has been put into solar energy, wind energy and wave energy by various municipalities. And so I think that there's a huge driving force from what I would call grassroots people to become issuers. I wondered if John or Paul, you might care to tell me where you thought the issuer demand might come from. Obviously startups and potentially communities, but is there another source of issuer demand that I haven't yet considered or that might be of interest to our listeners?
John here. In our report that we focus as the generic area is the innovative startup sector, but what we're really saying is that it can be all small enterprises that fit within the sort of structure that we are looking at. So it may be broader than the innovative sector, but this small startup innovative sector is really what crowdsourced equity funding is in many ways directed at. And for those people who do invest and it turns out to be successful, it might be not only financially but psychologically extremely beneficial for them. When it comes to the public interest enterprises, we look at what our report, how we dealt with it, we looked at it in quite some detail, but one of the issues that arose, and we've summarised in the report, was the view that social or public interest enterprises should even have a lighter touch of regulation than what we're proposing ordinarily for crowdsourced equity funding. I thought it was very important at the end of Chapter 2 to spell out all those particular views, but CAMAC also took the position that it was too early for us really to be able to make a final determination on that. I think that is going to be an interesting area for further debate amongst the public interest enterprise sector about whether they should have a even lighter touch of regulation than what we're proposing for issuers generally. I look forward to that particular debate. Our report sought to lay out for the general public the nature of the thinking by social enterprise about why they should have they should be given, if you like, a beneficial position, but we didn't reach a final conclusion. So my suggestion, 3 areas that of issuers will be the innovative startups, and for them I think crowdsourced equity funding, for some at least, if they can attract enough investors, I think it will be a huge boost and hopefully will be a benefit to the investors at the same time. For the public interest enterprises, I think there's a very important area here, and as I say, there is some further discussion to be done with the government about how they should be regulated. And the third is just small enterprises generally, some of whom may be able to get some tag-along benefit from crowdsourced equity funding. One final comment I make is given that the internet is borderless, when we're talking about issuers, we're not confining ourselves to Australian issuers, and our recommendations don't do so. So we're therefore issuers. To investors. We're not confining ourselves to Australian investors, so that issuers, when they put forward their offers through intermediaries, are just as entitled to attract money from overseas small investors as they are from local small investors. That may expand the opportunities for Australian startups to get access to funds, not only nationally but internationally.
Great, Paul. I'd ask you to consider the same question.
Yeah, well, our experience with equity crowdfunding is that when you see what works and what doesn't work, is that basically people aren't in there, investors don't come in there because they're going to get a percentage each year or get a dividend or something else like that. They basically want to buy a share at 5 cents, and then in maybe 3 years' time they sell it 10 cents. So it's capital growth thereafter. So therefore, if you step back from that and think, right, what gives the perception of capital growth? And often, as John's first category there of innovative startups, is that does give a perception that if I get in now, it's going to be better later on. And what we've found is things like property, retail, there's different industries that people just don't have that perception that if they buy a share at 5 cents, it could possibly be 10 cents in the future. And so really the categories that tend to be attractive and will attract equity crowdfunding will be those that people do have the perception that there is going to be a lift in the share value of what they got over a period of time. And we find that 3 years is about that. If they haven't really got a return by 3 years, then they don't really want to go much beyond that.
Gentlemen, I think we should, for time's sake, everybody's time is so generously been donated, start to wind things up. It would be great to have had some input from the Possible guys, but I've been assured by other mediums that they've tried everything to get online, but they've been thwarted by the technology gremlins, and I apologise for my own. John, you'll need to unmute yourself, but if you could do so, would you mind giving us your closing comments? And also, out of interest to our listeners, as I understand it, CAMAC is to be concluded and it hasn't received funding from the budget going forward. Is the CSEF legislation and recommendation that you put forward the last hurrah for CAMAC and the last hurrah for John Kluver, or will we hear more from you about this space in the future? John, I might need you to unmute yourself. I'm going to duck around and help you do that. In the meantime, Paul, if you could start doing some final comments for yourself, mate.
Okay. It's for capital raises. What is interesting about it is that you have to look at it really holistically in terms of the market of somebody raising capital, and the complexion often is that when you look at the statistics and the progress of a raise, in the beginning, the first few shares are often taken by people near and dear to the entity, friends, fans, family, and followers. And often, you know, they'll invest more than 2,500 because they know the people, they know the technology, they might live in the same area. There are emotional reasons why they're attached to that particular raising. As it gets on and later on, you can attract and sophisticated investors, and as Michael has pointed out, that's when you'd get a lead angel that might come in and say, look, I like this, these guys seem to be on the right path, and that in itself could bring in people from the crowd because that person is respected and honoured by the people in that investment place. So for me, in terms of, like, John's done an excellent job in his report, but what I feel that to really get the startup sector in that going is that there are other things that need to happen. And one of them is, of course, is sweat equity and employee share ownership plans. In the beginning, if you've got people in your company that are working hard but that you can't really afford to pay them, but you'd like to give them some shares, it's great if they could get them easily without having to pay the tax up front. So that's the employee part of it. And then the friends, the fans, the family, the followers, the customers, the suppliers, and people like that. It's easy to fill up those 20 people from that. And even if it went to 50 so that they complied with the PTY Limited, it would mean that you could get those people near and dear that knew and understood and honoured the company, that they could come in there and support the growth of it rather than being limited as it is now. And then, of course, later on the crowdfunding people would be invited in because it is recognised as a company that's moving forward, and then later on the angel. So I just think that this part of it was excellently and well done, but in the greater picture, the actual holistic, there's more of a holistic solution to really make it pump so that Australia can really truly deliver startups to the world that can be truly proud of.
Thank you, Paul. John, I think you're unmuted now and you should be able to talk. Or not, as the case may be. I think that you're now experiencing the same problem I had with my headphones, where you were unable to be heard even though you'd unmuted yourself. So
maybe he could come around and use your headphones. He could come around and use your headphones, maybe.
Yeah, that might be a great idea. Give me a second, gentlemen. Mike, you might be able to bring some more gems of knowledge out of Paul.
Yeah, look, I guess my closing comments would be that the vast majority of angel investors probably aren't in a position to be able to, assess early stage companies very well. They lack either the domain knowledge or the experience of early stage startup mechanics, so to speak. I think if it reflects what happens with what is happening with AngelList at the moment, where you've got certain syndicates where they've got 400 and 500 people in them, where they follow very popular angel investors, adjacent Calacanis of the world and so on. They write a syndicate deal that's quite an amazing scenario. What will happen in Australia is you'll have somewhere between 20 and super angels, for want of a better term, that the rest of the angel investors at $1,000 to $2,500 each will follow or pile in behind. And I guess I hope that in some ways the recommendation of what turns up as a final legislation isn't hamstrung by either a number of shareholders limitation, or two, a maximum per issuer that a shareholder can subscribe to, because you'd fairly well max that out pretty quickly based on the numbers we were talking about before. So ideally, hopefully, it won't be a hamstrung or a stillborn legislation.
Michael, if I can just answer something to that, that within the Australian regulation now, there is no reason why an angel list type operation can't function, because professional and sophisticated investors can actually invest now on that same basis, because every one of those people in angel list, to sign up, you must say that you are a professional and sophisticated investor. So, you know, that can happen now. There is nothing really stopping that type of thing. And indeed, that's what companies like Venture Crowd and Our Crowd are attempting to do in Australia, to utilize professional and sophisticated investors in these raises. But as you pointed out at the start of your comment, that is in later stages of a company's development usually, unless they have got extraordinarily compelling software or hardware. So angel list would be interesting when they pass Title III in America and see what the effect of moving into the area where Title III or unaccredited investors can invest in angel list type raisings. And that's when, as John said, that's when the rubber will meet the road, and we'll get the true test of whether or not there is a future in the crowd being involved in a lot of these transactions. But you could say, if a lead investor they are following, and they've been following, and the guy's exited a few times with good investments, then you can probably say that they're probably in better hands than if they just took a punt on something they randomly found out of 50 investment offerings on a platform.
John Kluver here. Just to answer some of the questions, first of all, in relation to the CAMAC report, yes, that is the final CAMAC report. We were advised at the time of the budget that CAMAC was to be discontinued. Our report was to be given to the government within a couple of weeks of that budget, and that work on our two remaining terms of reference, the future of the annual general meeting, a lot of which had matters dealing with the role of the internet in the operation of the annual general meeting, and how that could refurbish and revitalise the annual general meeting, that particular reference, which we were almost at a point of having a report on, and our work on managed investment schemes, which is a very large multi-billion-dollar industry in Australia, those matters to be handed over to Treasury. So that is our final report. I'm proud of it. We put an enormous amount of effort into it. We looked very closely at the overseas jurisdictions, and I can also say, and with Paul here as one of the contributors, we very closely reviewed all the submissions that were received, including from Andrew here, Andrew Ward as well. When you look at the report, you'll see that I've put in very tight sort of summaries of the submissions. One had to do that to keep the report in a manageable shape. But the submissions that came in from the various parties, we found of great value indeed, and I wish to thank everybody who did contribute in that particular way. It's now a matter for the government what to do with the report. We think it is very important that Australia be at the forefront in dealing with crowdsourced equity funding. We've provided all the information for the government to do so. Our original intention was to continue publishing as developments occurred, particularly as Canada reached a final position, which it'll do later this year, and as the SEC came out with it, when the SEC comes out with its final rules to implement crowdsourced equity funding in the US, which it will do later this year, our intention was to publish that and to update the report so that therefore Australia could be at the forefront. However, that won't be the case, and what you see is the final hurrah of CAMAC.
Off microphone, I'd like to say you could get crowdfunding to keep CAMAC going.
Yes, Andrew just said to me, that's true. Yes, maybe we'll try crowdfunding to keep CAMAC going. I tell you, we don't need much money. We were a very cheap entity for the government for what we produced. Our budget was extremely low. We had only myself and one other person as the full-time professional staff. We did all the background discussion papers and reports for the members themselves, many of whom put in an enormous amount of time for no cost at all. But yeah, we might crowdfund. That might be a good idea.
Thank you to John and to Paul and to Mike and for everybody for your patience as we've gone through what's been a rather clunky first off webinar for CSEF Australia and Startup88. Thank you all again for your time. Thank you, John. Thank you, Paul. Thank you, Mike. Thank you, Darren, for your work in the background. And in absentia, thank you, Rick and Alan. Thank you very much.
And thank you. Thank you for organising. Good job.